Have you ever wondered why some traders seem to catch every major move while you're still figuring out what just happened? Why they're already positioned for the next big swing while you're scrambling to react to price action that feels completely unpredictable? The difference isn't luck, and it isn't some secret indicator they're using that you don't have access to. The difference is how they see the market itself. If you've ever felt like you're always one step behind the market, hit that like button right now, because today I'm going to show you exactly how to think like the traders who are always one step ahead. Most retail traders are playing checkers while professionals are playing chess. They're thinking one move ahead while the pros are calculating 10 moves deep. They're reacting to what's happening right now while professionals anticipated this exact scenario weeks ago. This isn't about having better tools or more capital. It's about having a completely different mental framework for understanding market behavior. When you look at a chart, what do you see? Probably candles moving up and down, support and resistance levels, maybe some indicators flashing signals. That's surface level observation. When a professional trader looks at that same chart, they're seeing something entirely different. They're seeing a story unfolding, a sequence of events that makes perfect logical sense based on market psychology and institutional behavior. The amateur sees chaos. The professional sees order. The amateur sees random price movements. The professional sees calculated moves by smart money. The amateur reacts to what already happened. The professional anticipates what's about to happen next. This shift in perspective is what separates consistent winners from perpetual strugglers. Here's the truth that nobody wants to tell you. The market isn't random. It might look random on the surface, especially when you're caught up in the minute-to-minute price fluctuations. But underneath all that noise, there's a structure. There are patterns of behavior that repeat over and over again. Professional traders have trained themselves to see these patterns, while everyone else is getting distracted by the surface chaos. If you're ready to stop seeing chaos and start seeing the underlying structure that professional traders use to their advantage, make sure you're subscribed and hit that notification bell. This channel is dedicated to teaching you how to think like a pro, not just trade like one. Think about it like watching a movie. If you walk into a theater halfway through the film, you're going to be confused. You won't understand why the characters are making certain decisions or what's driving the plot forward. But if you've been watching from the beginning, everything makes perfect sense. You can even predict what's likely to happen next because you understand the story that's been building. That's exactly how professional traders approach the market. They're not just looking at today's price action, they're looking at the entire story that's been developing over weeks, months, even years. They understand the context that gives meaning to every single candle on the chart. Most traders focus on finding the perfect entry signal. They're obsessed with indicators, patterns, and technical analysis tools that promise to tell them exactly when to buy or sell. But here's what they're missing. The entry is just one small piece of a much bigger puzzle. Professional traders spend most of their time analyzing the bigger picture before they even think about where to enter a trade. They're asking different questions. Instead of asking where should I buy, they're asking why would smart money want to push price higher from here. Instead of looking for the next support level, they're analyzing what institutional players are likely planning 3 moves ahead. Instead of reacting to breakouts, they're anticipating where those breakouts are most likely to occur and positioning themselves accordingly. This difference in approach changes everything. When you're always reacting, you're always behind. When you're anticipating, you're ahead of the curve. When you're focused on entries, you miss the bigger forces at play. When you understand those forces, entries become obvious. The most successful traders have developed what I call market vision. It's the ability to see beyond the immediate price action and understand the deeper currents that drive market movement. This isn't some mystical ability that you're either born with or without. It's a skill that can be learned and developed through proper training and experience. Market vision starts with understanding that price doesn't move randomly. Every significant move is driven by someone with serious capital making calculated decisions. These aren't emotional retail traders panicking or getting greedy. These are institutions, hedge funds, and smart money players who move markets for specific reasons at specific times. When you start thinking like these players instead of thinking like a typical retail trader, your entire perspective shifts. You stop asking what the market is doing and start asking why it's doing it. You stop focusing on what happened and start focusing on what's likely to happen next based on the logic of market structure and institutional behavior. Professional traders also understand something that most retail traders never grasp. The market is designed to confuse the majority. It's designed to make obvious moves look risky and risky moves look obvious. It's designed to shake out weak hands right before major moves and to trap aggressive traders at exactly the wrong time. This isn't conspiracy theory thinking. It's simple market mechanics. When everyone is positioned the same way, someone has to be on the other side of those trades. And that someone usually has deeper pockets and better information than the crowd. Professional traders position themselves with smart money, not against it. They've learned to read the signs that indicate when the majority is about to get trapped. They can sense when retail sentiment is getting too extreme in one direction. They understand market psychology well enough to know when fear or greed is about to create opportunity for those positioned on the right side. This is why professional traders often seem to enter positions that look completely wrong at first. They're buying when everyone else thinks the market is about to crash. They're selling when everyone else is convinced prices can only go higher. They're not being contrarian just for the sake of it. They're positioning themselves based on their understanding of market structure and the predictable behavior of different market participants. The key insight is that markets move in cycles, and these cycles are driven by human psychology and institutional behavior patterns that repeat over time. Once you understand these patterns, you can start to anticipate where the market is likely to go next instead of always being surprised by what it does. Professional traders have also mastered the art of patience. While retail traders are constantly looking for action, professionals are content to wait for the perfect setup. They understand that the best opportunities don't come every day or even every week. But when they do come, they're prepared to act decisively with size. This patience comes from confidence in their analysis and their ability to read market structure. They don't need to trade every setup they see because they know that the highest probability opportunities will present themselves if they just wait for the right conditions to align. Most importantly, professional traders think in probabilities rather than certainties. They don't need to be right on every trade because they understand that trading is a numbers game played over many trades. They focus on finding situations where the odds are heavily in their favor and then position themselves accordingly. This probabilistic thinking allows them to stay calm and objective even when individual trades don't work out as expected. They don't take losses personally because they understand that losses are simply part of the cost of doing business in a probabilistic endeavor. The combination of market vision, patience, and probabilistic thinking creates a completely different trading experience. Instead of being stressed and reactive, professional traders are calm and proactive. Instead of being surprised by market moves, they're positioned for them in advance. They're not hoping the market will do what they want. They're prepared for whatever the market decides to do, and that preparation gives them a massive edge over traders who are constantly caught off guard. But how exactly do they develop this market vision? How do they train themselves to see what others miss? The answer lies in understanding market structure on multiple levels simultaneously. While most traders focus on a single time frame, professionals are constantly analyzing how different time frames interact with each other. They're looking at the monthly chart to understand the long-term trend and major structural levels. They're studying the weekly chart to see how current price action fits into the bigger picture. They're analyzing the daily chart to identify key support and resistance zones. And only then do they drop down to lower time frames to find precise entry and exit points. This multi-time frame analysis gives them context that single time frame traders completely lack. They understand whether they're buying into strength or weakness. They know if they're fighting the bigger trend or trading with it. They can see when short-term moves are likely to continue and when they're likely to reverse based on higher time frame structure. Here's your homework. Pick one market you trade and analyze it on monthly, weekly, daily, 4-hour charts. Then go down to 1 hour, 15-minute, 5-minute charts. See how the story changes as you zoom in and out between each chart. Share your biggest insight in the comments below. Professional traders also pay attention to things that don't show up on price charts. They monitor market internals, sector rotation, currency correlations, and economic data flows. They understand that everything in the financial markets is connected, and moves in one market often foreshadow moves in another. When they see unusual options activity or changes in market breadth, They're connecting those dots to potential price movements before those movements become obvious on the charts. They're reading between the lines of market behavior in ways that pure technical analysis cannot capture. Another critical difference is how they handle information flow. Retail traders often get overwhelmed by the constant stream of news, analysis, and opinions flooding social media and financial websites. They're constantly second-guessing themselves based on the latest headline or expert opinion. Professional traders have learned to filter signal from noise. They focus on information that actually moves markets rather than information that just creates temporary volatility. They understand the difference between news that changes fundamental conditions and news that simply creates short-term emotional reactions. More importantly, they've developed the discipline to stick with their analysis even when popular opinion is running in the opposite direction. They trust their process more than they trust the crowd because they've learned that the crowd is wrong at critical turning points more often than it's right. This isn't about being stubborn or ignoring new information. It's about having enough confidence in their analytical framework to avoid being whipsawed by every piece of conflicting data that comes along. They update their analysis when the evidence truly warrants it, but they don't abandon their position every time someone on social media disagrees with them. Professional traders have also mastered something that's incredibly difficult for most people to learn. They've separated their ego from their trading results. They don't need to be right to feel good about themselves. They don't take market movements personally. They understand that the market doesn't care about their opinion or their position. This emotional detachment allows them to cut losses quickly when they're wrong and let profits run when they're right. They don't hold on to losing positions hoping they'll come back because admitting they were wrong would hurt their ego. They don't cut winning positions short because they're afraid of giving back profits. They treat each trade as nothing more than a business transaction with a calculated risk and reward profile. This business-like approach eliminates most of the emotional decision-making that destroys retail traders' accounts. The way they think about risk is fundamentally different too. While retail traders often think about how much money they could make on a trade, professionals think first about how much they could lose. They size their positions based on their maximum acceptable loss, not their profit target. This risk-first mindset keeps them in the game long enough for their edge to play out over many trades. They understand that preservation of capital is more important than any single trading opportunity, no matter how attractive it might appear. They also think about correlation and portfolio risk in ways that most traders never consider. They don't just look at individual trade risk. They analyze how their positions might behave in different market scenarios and avoid taking multiple positions that could all move against them simultaneously. Professional traders have developed systematic approaches to everything they do. They don't rely on gut feelings or inspirational moments to make trading decisions. They have specific criteria for entering trades, managing positions, and exiting trades. They follow these systems religiously, even when their emotions are telling them to do something different. This systematic approach removes much of the guesswork and emotional turmoil from trading. Instead of constantly wondering what to do next, they simply follow their predetermined rules. This doesn't guarantee success on every trade, but it ensures consistency in their approach over time. They've also learned to think beyond individual trades and focus on their overall trading performance. They measure success over weeks and months, not individual positions. They understand that even the best trading systems will have losing streaks, and they're prepared psychologically and financially to handle those inevitable drawdowns. Measuring success over months instead of individual trades is a game changer. If you've been judging your trading success by your last few trades, you need to see this perspective shift. Share this video with another trader who needs to hear this. This long-term perspective allows them to stay patient during difficult periods and avoid making desperate decisions that could damage their accounts. They know that if they stick to their process, the probabilities will work in their favor over time. Perhaps most importantly, professional traders never stop learning and adapting. They understand that markets evolve, and what worked yesterday might not work tomorrow. They're constantly refining their approach based on changing market conditions and new information. They study their winning trades to understand what they did right. They analyze their losing trades to identify areas for improvement. They're always looking for ways to increase their edge and reduce their risk. This commitment to continuous improvement keeps them ahead of the curve as markets change and evolve. While retail traders often stick with the same approach year after year, professionals are constantly adapting to stay relevant in dynamic market conditions. But adaptation isn't just about tweaking strategies or adjusting timeframes. Professional traders adapt their entire mental framework based on what the market is teaching them. They understand that the market is the ultimate teacher, and every loss is a lesson in disguise. While retail traders get frustrated when their analysis doesn't work out, professionals see failed trades as valuable data points that improve their future decision making. This learning mindset creates a compounding effect over time. Each mistake becomes wisdom. Each loss becomes insight. Each challenging market condition becomes experience they can draw upon later. They're building a mental database of market behavior that gets richer and more sophisticated with every trading session. The way professionals handle uncertainty is another crucial difference. Retail traders want certainty. They want to know exactly what the market will do next, and they get uncomfortable when they can't predict outcomes with confidence. This need for certainty often leads them to overanalyze, second-guess themselves, or freeze up when faced with ambiguous market conditions. Professional traders have made peace with uncertainty. They understand that uncertainty is the only certainty in trading. Instead of trying to eliminate uncertainty, they've learned to profit from it. They position themselves to benefit, regardless of which direction the market chooses to move. This comfort with uncertainty allows them to act decisively, even when they don't have perfect information. They don't need to know exactly what will happen next because they've prepared for multiple scenarios. They can pull the trigger on trades that retail traders would pass on because they're not quite sure enough. The concept of market timing takes on a completely different meaning for professionals. While retail traders often think of timing as finding the perfect moment to enter a position, professionals think of timing in terms of market cycles and phases. They understand that certain strategies work better in trending markets, while others work better in ranging markets. They're constantly assessing what type of market environment they're in and adjusting their approach accordingly. They don't try to force their favorite strategy to work in all conditions. Instead, they have different tools for different market phases, and they know when to use each one. This market phase awareness prevents them from fighting the market's natural rhythm. When volatility is low and ranges are tight, they trade smaller and focus on mean reversion strategies. When volatility expands and trends develop, they trade larger and focus on momentum strategies. They flow with market conditions rather than against them. Professional traders also understand the importance of position sizing in a way that most retail traders never grasp. They don't just think about how much to risk on each trade. They think about how position size affects their psychology and decision-making ability. They know that when positions are too large, fear takes over and they make poor decisions. When positions are too small, they don't have enough skin in the game to stay focused and disciplined. They found the sweet spot where their position size is large enough to matter, but not so large that it creates emotional interference. This psychological position sizing is often more important than mathematical position sizing. They understand that the best risk management system in the world won't help if they're so scared of losing that they can't execute their plan properly. The relationship between confidence and humility is something that professionals have mastered in a way that creates a powerful competitive advantage. They're confident enough in their abilities to take calculated risks and stick with their analysis when others are panicking. But they're humble enough to admit when they're wrong and change course quickly when the evidence contradicts their position. This balance between confidence and humility allows them to be aggressive when opportunities present themselves while remaining defensive when conditions are uncertain. They can press their advantage when they have a strong edge while cutting their losses quickly when they don't. Retail traders often struggle with this balance. They're either overconfident and take too much risk, or they're too humble and miss opportunities because they don't trust their analysis. Professional traders have calibrated this balance through years of experience and self-reflection. The way professionals think about market information is fundamentally different from how retail traders process the same data. When economic news comes out, retail traders often react immediately, based on whether the number was better or worse than expected. They assume that good news means prices should go up and bad news means prices should go down. Professional traders understand that markets often move in the opposite direction of what the news would suggest. They know that by the time news is public, it's often already been priced into the market by those with earlier access to information. They're more interested in how the market reacts to news than in the news itself. They pay attention to market internals and price action around news events rather than just the headline numbers. If supposedly bullish news causes selling, that tells them something important about underlying market sentiment. If bearish news is met with buying, that suggests strong underlying demand. This sophisticated understanding of how information flows through markets gives them an edge in interpreting market behavior that goes beyond simple technical analysis or fundamental analysis. They're reading the market's reaction to information rather than just the information itself. Reading the market's reaction to news instead of just the news itself is next-level market analysis. If this concept is new to you but makes perfect sense, you're ready for more advanced content like this. Make sure you're subscribed for more professional level insights. Professional traders have also developed an intuitive understanding of market psychology that allows them to anticipate crowd behavior. They know that most market participants are driven by fear and greed, and they can recognize when these emotions are reaching extremes that typically precede major market moves. They understand that when everyone is extremely bullish, there are few buyers left to push prices higher. When everyone is extremely bearish, there are few sellers left to push prices lower. These sentiment extremes create opportunities for those who can recognize them and position themselves accordingly. This contrarian thinking isn't about being different for the sake of being different. It's about understanding crowd psychology well enough to know when the crowd is likely to be wrong. They can sense when popular opinion has become so one-sided that a reversal is probable. The discipline that professional traders exhibit goes far beyond just following trading rules. It's a comprehensive approach to self-management that encompasses everything from sleep and exercise to information consumption and social interactions. They understand that trading performance is affected by their overall physical and mental state. They maintain consistent routines that support optimal decision-making. They avoid activities that could impair their judgment. They surround themselves with people who support their trading goals rather than distract from them. They treat trading as a profession that requires professional standards of preparation and execution. This holistic approach to trading creates a foundation for consistent performance that goes beyond any specific strategy or system. They've optimized their entire lifestyle to support their trading success, and this comprehensive approach gives them significant advantages over traders who only focus on charts and strategies. The way professionals handle drawdowns reveals another crucial difference in mindset. When retail traders experience a series of losses, they often panic and start changing everything about their approach. They abandon systems that have worked in the past because they're not working right now. They jump from strategy to strategy looking for something that will immediately get them back to profitability. Professional traders understand that drawdowns are inevitable and temporary. They've stress tested their systems over long periods and multiple market conditions. They know that their edge will reassert itself over time if they stay disciplined and stick to their process. During difficult periods, they often reduce their position sizes rather than abandon their approach entirely. They maintain their analytical framework while being more selective about which trades they take. They use drawdowns as opportunities to refine their skills rather than as reasons to completely overhaul their methodology. This patience during difficult periods is what allows them to be in the right position when market conditions shift back in their favor. While other traders are still experimenting with new approaches, professionals are ready to capitalize immediately when their edge returns. The concept of market leadership is something that professional traders monitor constantly, but retail traders often ignore completely. They understand that different sectors, currencies, or asset classes take turns leading market moves, and they position themselves accordingly. When technology stocks are leading the market higher, they focus their attention on tech names rather than trying to force trades in lagging sectors. When commodities are in a bull market, they look for opportunities in resource-related investments. They follow the money flow rather than fighting it. This leadership awareness helps them identify where the strongest trends are likely to develop and where the most profitable opportunities are emerging. They don't waste time trying to catch falling knives in weak sectors when strong sectors are offering better risk-adjusted returns. Understanding market leadership also helps them anticipate when trends might be changing. When previous leaders start showing weakness and new sectors begin to emerge, they recognize these rotation patterns and adjust their focus accordingly. Professional traders have developed an almost surgical precision in their execution that comes from years of practice and refinement. They know exactly how they want to enter positions, how they plan to manage them, and under what conditions they'll exit. This precision eliminates hesitation and second guessing that can turn winning trades into losers. They've practiced their execution process so many times that it becomes automatic. They don't have to think about the mechanics of placing orders or adjusting stops. Their focus can remain entirely on reading market conditions and making strategic decisions. This execution mastery allows them to take advantage of fleeting opportunities that other traders miss because they're still figuring out how to place their orders properly. Speed and precision in execution often mean the difference between catching a move and watching it happen without participation. The development of this execution skill requires thousands of hours of practice and constant attention to improvement. Professional traders are always looking for ways to shave milliseconds off their reaction times and eliminate any friction in their trading process. Perhaps the most important difference between professional traders and everyone else is their relationship with the market itself. They don't see the market as an adversary to be conquered or a puzzle to be solved. They see it as a dynamic system to be understood and respected. This respectful relationship creates a different energy around their trading. They're not fighting the market or trying to impose their will upon it. They're working with market forces and positioning themselves to benefit from natural market movements. This cooperative approach reduces the stress and emotional turmoil that characterizes most retail trading experiences. Instead of being in constant conflict with market movements, they find themselves in harmony with market rhythm and flow. This harmonious relationship with the market fundamentally changes how they approach every trading session. While retail traders often wake up with preconceived notions about what the market should do or what they want it to do, professionals wake up curious about what the market will teach them today. They approach each session with an open mind and flexible expectations. They understand that the market is constantly evolving, and yesterday's winning strategy might not work today. This adaptability isn't reactive, it's proactive. They're constantly monitoring market conditions for subtle shifts that signal when it's time to adjust their approach. They can sense when volatility patterns are changing, when correlations are breaking down, or when new themes are beginning to drive price action. This sensitivity to market evolution gives them a massive advantage over traders who stick rigidly to one approach regardless of changing conditions. They're like skilled surfers who can read the ocean and adjust their technique based on the waves they're facing, while other traders are trying to surf every wave the same way. Professional traders also possess something that's incredibly rare among retail participants. They have genuine patience for the right opportunities. This isn't the nervous waiting that characterizes most amateur traders, where they're constantly looking at their screens hoping something will happen. This is the calm, confident patience of someone who knows exactly what they're looking for and is willing to wait as long as it takes. They can sit for hours without taking a single trade if market conditions don't meet their criteria. They understand that forcing trades in suboptimal conditions is one of the fastest ways to lose money. Their patience isn't passive, it's active and strategic. They're using that waiting time to study market behavior, refine their analysis, and prepare for when the right setup finally appears. When that perfect setup does materialize, they act with decisive speed and confidence. There's no hesitation, no second guessing, no fear of being wrong. They've done their homework, they understand the probabilities, and they execute with precision. This combination of infinite patience followed by immediate decisive action is a hallmark of professional trading. The way professionals think about competition is another crucial differentiator. Retail traders often view trading as them versus the market, as if they're in some kind of personal battle with price movements. Professional traders understand that they're not competing against the market. They're competing against other market participants for the best opportunities. They know that on the other side of every trade is another human being making a decision based on their own analysis and emotions. Their job is to identify situations where they have better information, better analysis, or better emotional control than whoever is taking the opposite side of their trade. This competitive mindset makes them constantly seek edges that others don't have. They're always looking for new sources of information, better analytical tools, or improved psychological techniques that give them advantages over other market participants. They understand that standing still in trading means falling behind. They also recognize that the most profitable opportunities often come from situations where retail traders are making predictable emotional mistakes. When they see clear signs of panic selling or euphoric buying among the retail crowd, they position themselves to profit from these emotional extremes. Professional traders have developed sophisticated methods for reading market sentiment that go far beyond simple technical indicators. They can gauge the collective emotional state of market participants through subtle clues in price action, volume patterns, and market internals. They've learned to interpret the market's body language. When they see certain combinations of price and volume behavior, they can sense whether buying or selling is being driven by informed money or emotional money. They can distinguish between institutional accumulation and retail speculation. They can identify when smart money is distributing shares to eager retail buyers or accumulating shares from discouraged retail sellers. This ability to read the emotional undercurrents of market activity gives them insight into likely future price movements that pure technical analysis cannot provide. They're not just looking at where price has been. They're interpreting the psychology behind those price movements to understand where price is likely to go next. Reading the emotional undercurrents of market activity is an advanced skill that takes years to develop. If you want me to create content specifically about reading market psychology and sentiment, let me know in the comments and make sure you're subscribed. The risk management philosophy of professional traders extends far beyond simple stop-loss orders. They think about risk in layers and dimensions that most traders never consider. They're managing position risk, portfolio risk, correlation risk, and even career risk simultaneously. They understand that their biggest risk isn't any single trade going wrong. Their biggest risk is a series of seemingly unrelated positions all moving against them at the same time due to some broader market shift they didn't anticipate. They structure their positions to avoid these correlated risks that could damage their entire portfolio. They also think about the risk of being out of the market during major moves. While retail traders often focus only on the risk of losing money, professionals also consider the opportunity cost of missing significant trends. They balance these competing risks by maintaining some market exposure even when they're not completely confident about short-term direction. Their position sizing reflects this sophisticated risk thinking. They don't just calculate position size based on their stop-loss level. They consider how each position fits into their overall portfolio, what correlation it has with their existing positions, and how it might behave under different market stress scenarios. The gap between professional traders and everyone else isn't about secret formulas or exclusive access to information. It's about developing a completely different way of seeing market behavior. If this video has opened your eyes to how professionals really think, I need you to do 3 things. First, hit that like button because this perspective needs to reach every trader who's tired of thinking small and ready to think like the professionals. Second, subscribe and turn on notifications because I'm committed to teaching you the professional mindset that actually moves accounts, not just the surface level strategies that everyone else is teaching. Third, tell me in the comments, what's the biggest mindset shift you're taking away from this video? Which professional thinking pattern are you going to start developing first? And if you're serious about developing true market vision, check out the video I'll link on screen about reading institutional behavior. It's the perfect next step for traders ready to think like professionals instead of just following retail patterns. Remember, while most traders are reacting to what already happened, professionals are positioning themselves for what's likely to happen next. They've trained themselves to think in probabilities instead of certainties, to read market psychology instead of just price patterns, and to maintain discipline when emotions are screaming at them to do something different. This isn't magic. It's a learnable skill set that comes from understanding market structure, respecting uncertainty, and developing the patience to wait for high probability opportunities. Start seeing the market through their eyes and everything changes. Until next time, stop playing checkers and start playing chess. The market rewards those who think like professionals.